welcome to the Company Value Investor. In today's video we are going to analyze the Southwest company, the Southwest Airlines company. Let's go to 2016. Okay, this is the ticker symbol. The current price for Southwest Airlines is $58.73. The rate that they need to attain to meet the expectations of their owners, their creditors, is 15%. The amount expected is negative 442. The company's real earnings in 2016 was $951, and the amount needed for Southwest Airlines to maintain their operations is negative 14,057. Okay, for the average investor, the price is your FICO score. The rate needed is the credit card interest that you pay. The amount expected is the amount you need in order to make all of your payments. The amount made, the real earnings, is the actual amount that you made either on a monthly or yearly basis. And the last one, the amount needed, is the amount you need to maintain your lifestyle. Okay, in 2016, the Southwest Airlines had a strong stock. The stock was undervalued and it was profitable. How do I know it's a strong stock? Well, one is the earnings per share is 3.27. That combined with the price to book ratio, which is 4.1, and the fact that the retained earnings was almost 90%, makes it a strong stock. The stock was undervalued because currently it's $58. It should be more like $62, $63, and it's profitable. Why? Because in 2016 they had real earnings of $951, and the amount expected was negative 442. So that makes it a profitable company. Now let's do the analysis for a couple of years so that we know we're dealing with a good company. 2015, again, strong stock, undervalued stock, and again it was profitable. So 2015 and 2016, good years. How do I know it's profitable? The real earnings, not the net profit. This is the real earnings. The real earnings is $11.56, and the amount expected for their obligations was negative $245. So that makes it profitable. Let's go to 2014. 2014, the stock again was strong, and we're basing everything on the current price and the financial statements. 2014, the stock was undervalued. However, in 2014, the company was not profitable. Why? Because they had a real earnings of $454. However, the amount expected was negative $759. So that makes it a not profitable corporation for 2014. Let's go to 2013. Again, strong stock, overvalued stock, and it was not profitable. So 2 out of the 4 years were very, very good. The last 2 years. Let's break it down a little further now. Okay, so in 2016 they had positive cash flows. It's very important. 2015 they also had positive cash flows, which is the reason why those 2 years Southwest Airlines had a strong stock, and the stock was undervalued, and it was profitable. However, in 2014 they had negative cash flows, and in 2013 they had positive cash flows. So the reality is, for the last 4 years they've had good cash flows, positive cash flows. The problem is, well, not the problem, the question is, would I invest in this company? Well, let's find out. Let's run a if I was to invest $10,000 in this company today, it would give me about $12,000 a little over $12,000 in 2018. Okay, but the way that I would make a 2,900 profit, or a 29% interest on my investment, on my initial 10,000 investment, is if Southwest Airlines can somehow average a 10% rate of return. They're expected to get 15%. If they can get 10%, then I'm guaranteed a very good profit on my initial $10,000 investment. However, the issue that I have is Southwest Airlines, they tend to average about 5% interest on their return. So they're not meeting these expectations. But if they can get a 10%, then they'll meet my expectations. Historically, they've averaged about 5%. 5%. Yeah, about 5% on their investments. In 2014, they averaged a little under 3%. So, do I have the confidence of investing $10,000? No, not because it's not a good company, but because they haven't. Well, I don't think they'll be able to attain a 10% rate of return. They're expected a 15. They've averaged 5. I don't think they'll be able to get 10%. Now let's try a $1,000 investment. If I invest $1,000, I would get 17 shares of Southwest Airlines, and I would profit about $30 of an interest rate of a little under 3%, which is good because they've averaged 5%. So if I invest $10,000, I will see a profit and an interest increase. My rule is that I have to get an interest. I have to make an interest in my investment more than I would pay my credit card company. So I have to make at least 20% on any investment that I make. In order for me to invest in this company, I would have to invest $4,000. That gives me 11%. No. The question is, would I invest in Southwest Airlines at this moment? No, I wouldn't. Only because I don't think they can attain a 10% interest rate on their investments. They've averaged 5%. They should be making about 10% in order for me to attain the kinds of profits that I'm looking for. Maybe in about 6 months, the price would change, and that'll make it a more attractive investment. But as of now, even though the last 2 years Southwest has done really well, and they've had positive cash flows the last 3 out of the last 4 years, which is really good. The fact of the matter is, one of my criteria is they're not able. I don't think they're able to attain a 10% interest rate on their returns. I don't think that they should be getting 15. They've averaged 5. I don't think they'll get 10%, and I wouldn't invest mainly because of that reason. Otherwise, if they were to, provide a 10% or 9%, then I would seriously consider investing in this company. But as of now, the question is, would I invest in Southwest Airlines? No, not at this moment. Maybe 6 months from now, we'll do the analysis again, and based on the price, we'll go from there. That is it for this video. As always, keep investing.